lot of once-in-a-lifetime events have happened. There have been a twin crisis that has arisen in the business that has been created by both an oversupply of crude oil that's been generated through the OPEC Plus membership and their failure to enter into agreements on restricting that output as we move through the beginning of this year, as well as just the demand destruction that has occurred as a consequence of the shutdowns as we all practice social distancing and have been trying to stay safe. There's been no part of the energy business that's gone unscathed in all of this. It's not just in crude oil and natural gas. If you look at electricity, refined products, commodity chemicals, whatever the sector may be, everyone has taken some sort of hit or another. In most instances, it's been pretty significant. The good news that I'm here to talk to you about today is the fact that I think the worst is likely behind us. And the other good news, and this is starting to build and has been building all week, is that a recovery seems to be underway right now. The not so good news is that there's still a lot of uncertainty out there, and that clouds the speed of recovery and kind of the strength of the recovery in this sector, as well as a lot of other important economic sectors in our economy. And time is really, really important, as I'll suggest to you, and as we'll go through some slides a little bit later. Getting to the fall and to the winter is very, very important for the energy business. The anticipation is that things will change by that time period. If there's anything that creates uncertainty for us to get to that recovery period as we move through the fall and the winter, that's going to make it much, much more difficult. So a healthy and sustained recovery is one of the things that I would argue is probably the best medicine for recovery for the sector. I know there are lots of legislative and public policy arguments out there for doing this, that, and the other. But at the end of the day, getting people back to work and getting the economy moving in a safe and healthy fashion is probably going to be the best policy outcome that we can have that helps the industry. So what I want to do is go through a couple of slides that give you kind of some background on this recovery that I talked about before and where we've been. Now, as I mentioned earlier, this is a bit of a once-in-a-lifetime type event, but there has been instances where we've seen relatively large price crashes and reactions to those, and they provide, I think, some inference in kind of where we might find ourselves in response to the current crisis and where we may be coming out of this as we move through. So going back to that last crisis, which occurred during the 2014 time period, I've got a chart here that looks at crude oil prices over on the left-hand side and natural gas prices on the right-hand side. And you can see that they tend to be pretty coupled most of the time. There's been a decoupling period after you see this big drop in prices after the 2009 recession and financial crisis. You notice here we had really high prices, as many people remember. After the recovery, natural gas stayed relatively low. And then we had this big drop in 2014. This was precipitated by the Saudi Arabians and OPEC flooding the market. During this time period, unconventional crude oil in the United States was becoming more and more developed. We were increasingly eroding away at OPEC's market share in world crude oil markets. By 2015, we had eliminated our exports ban, and we're actually competing globally. We weren't just deferring production that was imported into the United States. We were actually competing on a global basis. And the Saudis saw this as a threat, not just for us alone. Keep in mind that during this time period, it was all non-OPEC production. And that included what was going on in Russia, where you were hitting new post-Soviet era highs that were around 11 million barrels a day. So their idea of this was to flood the market, to crash prices, and we saw that significant crash there. It wasn't until we moved into the beginning of 2016 that the Saudis figured out that, look, we can't sustain this for a very long period of time. This type of action is hurting us just as bad, if not worse, than it is our competitors. And so they came up with this new OPEC Plus agreement. If you can't beat them, then join them. And so they tried to kind of divide and conquer by getting the Russians to move along with them in this OPEC Plus agreement that essentially reestablished some world order and prices. And you can see that build up as we moved from 2016 on. But OPEC realized they couldn't do it on their own and had to have some support. And we've been in that situation since then. Now we've got this crisis that's been created by the COVID situation and the demand destruction. And what does it mean as we look at perhaps this last 2014 crash, and what are those parallels and what do they mean maybe potentially for the recovery here? So let's go back and kind of blow up some of these numbers. I'm going to go through a series of charts that kind of take the long picture, and then we'll blow up on the more recent time period. So this is, again, another picture of prices. Crude oil on the left, natural gas on the right. You can see very significant decreases in crude oil prices. And in fact, we went negative, as some of you may realize, back at the tail end of April, down to about minus 32 or minus $37 on the front month contract on the NYMEX. primarily due to some storage concerns and the inability or the concern that we would be unable to essentially store all the crude oil that was in excess of market demand. We've seen price decreases for natural gas. This is important for us in Louisiana, given the revenues that we get from the Haynesville Shale from a mineral revenue perspective. But those decreases are clearly nowhere near in percentage terms what we've seen occur in crude oil prices. As we look at kind of what happens with production and prices, you can see that it's a relatively stable relationship. Once you've drilled those wells, that production will continue to climb. If you look at that 2014 time period where we had the contraction, we had about a 71% price drop. You measure that with where we are today at 60%. It's certainly comparable in terms of the overall percentages. Obviously, the order of magnitude going from somewhere around $100 to $20 is one thing. Going from essentially $50 to minus 37 is a little bit another, particularly on market psychology at the time. However, if you look at kind of where the production declines occurred during that time period, we stopped drilling wells. Obviously, you stop drilling wells, you're going to slow down production because natural decline kicks in. And we had about a 1.1 million drop or 12% decline. So that's somewhere around what we'll call a supply elasticity of 17. That is for every 10% drop in prices, you're seeing about a 1.7% decrease in output during that time period. Let's go back and kind of blow up these numbers here on the weekly basis. And again, you can see the more contemporaneous time period. If we're kind of looking at that relative to what we did in 2014, we saw this significant decrease. We were peaking up around 13.1 million barrels a day. That was a record for the United States right prior to this crisis. So again, we were continuing to increase productivity in most of the wells and most of the basins that we were producing in, particularly the unconventional ones, as well as the deepwater Gulf of Mexico. And then you can see this fall off in production that is correlated with prices. Interestingly enough to me is that decrease is only somewhere around 11%. That is comparable on a relative basis. You're still getting a supply elasticity of somewhere around 17.9, which is somewhere close to what we saw in terms of the responsiveness of the price decrease in 2014. And it's really only about a 1.5 million barrel decrease right now. So even though things are very, very bad out there, I think one of the take homes that's been interesting to me in all of this has been the resiliency that we have seen in production, at least in these early days. There's still a lot more to go, but so far we've seen some pretty good resiliency. We certainly are down relative to our record levels, but we certainly are not down as low as the 3 to 5 million barrels a day that a lot of people were anticipating would happen almost overnight. Again, this chart gives you, I think, a good flavor for why the Saudi Arabians were very interested in flooding the market in 2014 and why they continue to be concerned about U.S. unconventional reserves and unconventional production. If you look prior to the recession, U.S. production accounted for somewhere around 7% of market share. And you can see that recovery period that I was telling you about before, after the recession. And as the unconventional revolution took off in crude oil in the United States, those started to peak out around 12 to 13 to 14%. The Saudis flooded the market. We got a small decrease, maybe about 1% or so in world market share. Saudis kind of gave up on that arrangement, reestablished prices. And again, we've been increasing since that time. We are still at a relatively healthy level in terms of overall market share at somewhere around 17%. That is certainly down a little bit, a few basis points from where we were before, but still relatively good and relatively healthy. For those of you that aren't familiar, the United States has been, over the last year, the largest crude oil producer in the world. What stands to be determined is where this kind of rank order will fall out as we move forward. If United States production starts to curtail any more than what we've seen now, if it does start to get into that 3 to 5 million barrel range reduction, you're going to see the Russians probably ante up here to the top spot, and you'll probably see the U.S. move in the second, because as I'll talk about a little bit later, not only are the Saudi Arabians cutting back based on the OPEC Plus agreements that they signed just about a month ago, but they're also cutting back voluntarily by another million barrels. It's going to put them almost down to a threshold point below 8 million barrels, which is a point where historically they've said they've never gone or would never go, and in fact are going to wind up probably going there or there this right now as we move through the next couple of months, at least the next 2 months. Let's look at natural gas production. I won't belabor this too terribly long, but you can see the production trends here as we're mapping them on the left-hand side of the chart, price trends here. Again, looking at what happened, the correlation between natural gas prices and crude, the movement from $6 an MCF back down to about $1.73. Really big drop as we saw that during 2014. Consequence of a lot of supply coming to the market and just that correlation with crude oil prices. Natural gas was relatively flat. So it was pretty resilient. And a lot of that has to do with the fact that during this time period, we were still seeing considerable free gas or free natural gas being produced from a lot of these primarily crude oil producing wells, a lot of what we call associated gas. And there's concerns right now that if crude oil drilling starts to fall off, that it's not only going to impact crude oil supplies, but it may have some collateral damage on natural gas supplies, particularly as we are in the injection season right now, and we prepare to put away supplies of natural gas to meet our winter peaks in the winter in December and January. So there's some concerns that, and I'll talk about that in a little bit, that because of these contractions, this was an argument back in 2014, as you'll see, not really a strong argument during that time period. It's an argument again in the downturn that we're seeing right now, which is not as severe. We're starting to hear again in the 2014 time period. The 2017 time period. And again, you can see those trends again with gas production here on the left, again, peaking up to records that were in excess of 110 BCF a day. We're getting back down towards 100 BCF a day. Still a lot of gas. A lot of that gas was not being used in the U.S. market, was increasingly going out into the world market in the form of exports, which again, as many of you may recognize, as I've spoken about before, has been a great capital investment opportunity for the Gulf Coast and particularly for Louisiana. Again, looking back at the price collapse in 2014, you can see everybody essentially conserving capital budgets, backing off. This is a rig count by major unconventional basin for crude oil production. Obviously, the Permian has been kind of the darling of the industry, and primarily because this is one of the most productive and more productive crude oil producing basins in the U.S. After that contraction, you can see that a lot of people, no pun intended, drilled down more in the Permian than they did relative to some of the other areas such as Eagle Ford or in the Appalachian regions, in the Utica and other places. You can see a lot of this increase in the Permian came at the expense of the Eagle Ford, still within the state of Texas, but much better opportunities for leveraging and using a lot of option value in that area that you don't have in the Eagle Ford and other basins. If you look at rig counts and prices, the rig counts on the left, the prices on the right, you can see they're very correlated. As prices increase, rig counts increase. And again, we saw that crash in 2014. We also saw a relatively strong recovery as prices recovered, an almost immediate one. And again, we're looking again at a similar situation. We saw a peak to trough fall in 2014 from somewhere around 1,500 rigs to 300. That was a very big impact on the industry. But as I noted earlier on the supply numbers, the supply tended to be relatively resilient, primarily because well productivity, the amount we were getting from every well or from every rig that created a well, was increasing pretty rapidly during that time period as well. So it was offsetting in large part some of those natural production declines that occurred during that time period. We've gone from a trough of 316 up to 888 in our more recent peak, which I think was in November of about 18. And we're down again right now. I think we're at 292 rigs that are active right now as of this week. That is a new all-time record low. And so that doesn't bode well for the industry, because if you're not drilling in an unconventional environment, you're letting the natural decline of these wells take over in terms of overall supply. Many of these wells have very rapid decline curves, much faster than you see in kind of the old school conventional and traditional wells. And so in order to keep production moving, you really need to keep rigs going. And if rigs are falling to record lows, that is a big challenge. The key will be, are we going to see this kind of resilience as we move out of this curve in 2020 that we saw in 2014? The past history would suggest that it's a great opportunity to see that. Things are a lot different though today than they were in the past, and you can again see this kind of drop off, high correlation here between rigs and prices. Are we going to turn this around as we're starting to see prices turn around as well? A couple of things to keep in mind when you think about how the industry was able to essentially reestablish itself after 2014. A couple of big things that they were able to do that's going to be questionable on whether or not they can do today. Back during the 2014 correction, a number of companies had service company contracts. They had other supply chain arrangements, other equipment contracts that were set in a $100 barrel environment. You'll remember that long trend there after the recession where we were somewhere between $100, $145 a barrel. When people are moving that fast, being cost conscious at that point in time is not as important as getting rigs into place and securing acreage for future production. And that's really where you saw industry. There wasn't really strong cost containment incentives at that point, and shareholders really weren't expecting it, weren't demanding it at that point in time. That has all changed since then. But during that time period when we went to that run up in 2014, as you'll see in a little bit, wasn't such a big concern. All of those contracts got renegotiated by half or more. Is there still a lot of fat in this part of the business to be able to go in and find more efficiencies? There probably are some opportunities, but are they going to be as significant as we saw in 2014? Well, that's a really big challenge. The other thing that you saw industry do was cut back on labor force and employment. In Louisiana alone, we went from somewhere around 50,000 employees in oil and gas down to about 35. We have been at around 35 prior to this crisis. We're anticipating probably about another 5,000 employees are going to lose their job in the sector through our updates through our Gulf Coast Energy Outlook. Is that going to be somewhere industry goes to look for cost savings to survive this kind of challenge they've got to making it to the end of the year? Drilling and productivity gains at wells was also very important, as I mentioned earlier, not only in what I'll say the process of drilling and completing wells, that is drilling longer laterals, drilling more stages and more frac stages in each well, well spacing and drilling more wells closer to one another, but also focusing on efficient locations. So you saw the big concentrations in the Permian, which tended to be one of the more efficient basins that we've seen in the United States and one of the most productive. So you saw a lot of that. Are we going to continue to see that? That's probably going to be a very strong outcome. But again, there's diminishing returns in this business like they are in a lot of other businesses. Where are we kind of on that productivity curve? Are there a lot of opportunities to continue to do that as we move forward? That's going to be an important question that's going to have to get tested out. Financial issues were also different then than they were today. Prior to 2014 and even a little after 2014, unconventional oil and gas and energy in general was the darling of Wall Street, outperforming the S&P. That's not the case anymore. It hasn't been since about mid-2014 to today. And during that time period, you saw a lot of companies going out and issuing debt or borrowing from banks. Again, their capital structures right now are in a position where they're not able to do that, and that's going to be a big thing to think about. This will give you an idea of kind of that access to relatively affordable equity capital as you moved into 2014. That market correction as those prices started to fall. The gold line is the Standard & Poor's, so that's kind of the market average. You look at the oil and gas index for upstream exploration and production companies, you can see that is down and has continued to be down. And you can see the fortunes, at least from the financial perceptions of the industry, have changed considerably since 2014. You look at the leverage of the capital structure of many of these companies in terms of the debt that they hold. This is another big problem for many companies. Look at a company like Chesapeake that is somewhere around 113% of its capital structure in debt, Comstock at 135. You may ask, how does somebody have more than 100%? Well, a lot of that's negative equity. That means they owe more than what their assets are worth. But again, look after 2014, you've got companies like Devon that went from a 30% debt ratio to 54%. You've got Pioneer, also really relatively well-run companies from 23 to 30. And you can see that many of these companies have been trying to work this down, but they're all at levels that for some are relatively high. Chesapeake still at 94%, Comstock at 68%. Some of the other ones close to 50% as well. But that's not uniformly true. You look at Pioneer, who's worked really hard at cutting that down by about half. And I think this helps underscore who the winners and the losers may wind up being and who survives this challenge of making it through the end of the year and continuing to attract capital to sustain development as we move and to survive essentially as we move through the year and move into next year. So is the tide turning? And I think the answer to that is yes. Will it be strong and fast enough is what we don't know right now. The big race really is on surviving until demand flips with supply. And this is a chart that essentially looks at quarterly. I think it originates from information from the International Energy Agency. You can see these. The green line here is essentially demand on a quarterly basis. Second quarter, we are way off as much as 15 million barrels across the quarter on an average basis. On a monthly basis, for this month alone, we were looking at 30 million barrels of excess supply in the market, about 15 or so last month, about 5 months before. As we move into June, we're looking at maybe somewhere around another 5 to 6 in excess. And then as we move into the summer in July and August, those numbers start to flip. They're all based on some pretty optimistic outlooks on recovery and bringing people back to work and the resumption of normal activities. But if this occurs, you start to see essentially a burn off of inventory. So these bars start to move negative, which is essentially the stocks that we have. Demand starts to move above supply, and you start to see some price relief as we move to the end of the year. So this is the point as an oil and gas company that you're rushing for. This is the one that you've got to survive to and to get through these couple of months where we're at right now. And you need markets to essentially get you there, because that's going to be about the fastest, most efficient way you're going to be able to do that. The other thing that will help is essentially, and the thing that's going to help curtail a lot of the supply that you've seen here in this big contraction, has been the OPEC Plus agreements. They are now looking at a 23% cut that was instituted about a month ago from October 28 levels at somewhere around 10.2 million. That's not great when you're considering a 30 million deficit. But as we move into latter months where those numbers start to get to 5 or 6, you can see that that starts to have some meaningful impacts as we move through. The commitment runs through May and June. It drops down to 8 million as we move through the end of the year, and then to 6 million as we move into 2022. There will be a meeting in June, and there may be some discussions of changing and adding on to this. Still not clear. Look at where the Saudis have been as we move through the beginning of the year, and they started into that kind of predacious activity in terms of providing more and more and flooding the market. We went from 9.7 million to 10 million. They're back down to 9.8 million. Their agreement puts them at 8.4 million. They actually voluntarily agreed to take another million off about a week ago. That was kind of quietly reported at the beginning of the week. So that will put them below kind of their usual line in the sand of 8 million. And I think a lot of that has to do with their concerns about the market, as well as some of the geopolitical pressure they're getting from the United States. It so happens that coincided with an announcement from the United States that they were going to be removing essentially Patriot missile batteries out of Saudi Arabia. So this is very important for them to act in a way that is consistent with U.S. interest, and you're at least seeing that right here in the near term. So at least from an OPEC agreement, that twin crisis, this one aspect of it seems to have been taken care of and eliminated in the near term. The big question is who's going to be cheating. If you go back to the original OPEC agreements that were in place, on the 1.7 million that had been in place for since the 2016 recovery and agreement, a lot of these companies in here were cheating, particularly in places like Nigeria. Iraq was over a little bit. Iran at one time, when their crude oil was entering into the market, was cheating some as well. Certainly that won't be an issue right now, but that's always an issue when you're with a cartel, and you're with a cartel that relies on voluntary members like Russia and some of these other countries that are down here at the bottom. So compliance is going to be a big important issue with all of this. Crude stocks in the United States and how we're building inventory is something else that we're watching. This is what sent the market into a titsy when we went from somewhere around less than 50% up to 60% in a handful of weeks. This is what really sent that front month contract in April, that May 2020 contract, negative to a minus $37, because there was a concern that by mid-May, essentially where we are right now, that we would be close to running out of storage. That doesn't seem to be the case right now in the United States. And a lot of that has to do with some changes in market fundamentals, coming back to work and demand picking back up, and the fact that the market has been very, very creative at finding new places to store oil that people didn't even envision or think about prior to this crisis happening. There's been a lot of entrepreneurship, a lot of creativity that's been going on out there in terms of where people are putting oil. You look at the PAD 3 region, which includes the Gulf Coast. We're also at about 60% full right now. So we've got some wiggle room, not a lot. But as I told you earlier, and as I mentioned earlier, we need to get to July into August. That's the real big concern in all of this. And so that's if we can hold out before filling off all these tanks, if demand can continue to be strong, the likelihood of us not busting all that storage seems pretty good. You're seeing that right now. in terms of market prices. So the outlook right now on the NYMEX, this is from yesterday's prices, I haven't updated it this morning, are that we're seeing a gradual increase as we move through time in terms of contracts that are dated out into 2022 and beyond. If you look at the average across the next 6 months, you're looking at an average of about $33, which is certainly better than the 20 that we were at before, certainly better than the minus 32 that we were at the end of last month. On a 12-month basis throughout 2021, that builds to 35 and to 38. The contango that was very, very sharp, we were down at 20, and those numbers were rapidly increasing to 30. This has started to flatten out, which is good, which means the market is kind of seeing some more stability in terms of the outlook of supply as well as the excess supply. The fact that the differentials between Brent and WTI are starting to tighten a little bit also suggests that the problem in North America relative to the rest of the world is not quite as significant as it was, say, a couple of weeks ago. This has been something that has really dramatically changed, I would argue, just this week in the last 3 days. And as long as this continues to hold, I think the outlook continues to improve. But one of the things to keep in mind that at least as the world stands today and what we know, you got to get out to June 2028 contracts before you start breaking $50 again. And so there is going to be a different world that we're going to face in the energy business, and it's going to be one where prices are going to be consistently low. To me, it looks a lot like the natural gas market after the 2008-2009 recession. That was a market that never seemed to get its foot again. There were some brief pops in natural gas prices due to the polar vortex and some other things that occurred after that time period. But by and large, we've stayed in a tight trading range between 250 and 350 on natural gas over the last several years. And that could be the case in what we see in crude oil markets, a much tighter range at a much lower price deck than what we've seen historically. Same is true with natural gas. This will show you just how stable the contracts are as we move out into the future. A little bit of a peak here at $3. For the winter, the market thinks that we may have some natural gas shortages if we have a cold winter, and they're kind of banking on that, although this is down a little bit from where we were as recently as a couple of weeks ago, primarily because the associated gas concerns are tapering off some. You look at where the investment banks and EIA are looking at prices for the rest of the year. They're looking at averages on for the second half below 30. This is probably going to get revised up for many of these institutions. 32 to 35 next year. 32 is pretty consistent with the NYMEX. Some of these other ones have not released their 2021 outlooks yet because there's just still so much uncertainty. But look at where we've been historically between $50 and $65 a barrel, going back over the last 5 years or so. These are prices that are well below those historic norms and trends. Gas prices a little bit up from where we were last year. Goldman is kind of out here on the outlier at 350. As I mentioned earlier, they were prognosticating the same thing back in 2014, and it never materialized. And I had my doubts whether something like this would materialize this year, much for the same reasons. It didn't materialize back in 2014, and we had a strong economy. I don't see this materializing too terribly much this year with an economy that's considerably weaker than we were in 2015. So how about some conclusions, and what are we looking at here? I hope that you, in looking at these charts, you get a good feel for the fact that we've got a recovery that's underway. Prices are building, those differentials and the sharpness of that contango trend, that is, the latter dated contracts being significantly higher than the near term. Those have started to weaken. As I mentioned, the differentials are closing globally. We're starting to get some reversion and some consensus right now on prices. It's still early. A couple of days, a week doesn't make a trend in all of this. And information can certainly upset these markets, much like they can equity markets and other markets. So there's still a lot of the patient still is in intensive care. There's still a lot of concerns here, but things are looking better. Staying above 35 barrels is an important threshold level for the industry. Even at 35, you can get some select drilling and by select companies that have very preferable acreage positions like those in the Permian, and they have relatively stronger balance sheets. So the thing to watch is, are we going to bounce off that 292 number in terms of drilling rigs, or are these recent price bills that we're seeing now going to have an impact ever so slightly on flooring out that drilling rig activity to keep it from going any lower, and maybe even picking it up at the margin by a couple of rigs? That would start to confirm the information that's out there now that we've hit the bottom and we're starting to turn back up. However, getting to the winter and the fall is the big thing. And it's going to be doable for some firms. Many are not as leveraged as other. I gave you some examples earlier for some of those firms that are out there. Some have had price hedges on their production that run 3 months or so, and those have still not come off the books, but are starting to come off the books now. It's going to buy them some time. Many have taken strategic actions, such as continuing to produce and to store crude during this recent downturn and take a physical hedge and balance that off with essentially futures markets that are out in the $32, $35 range. And I think a lot of that has to do with the trends that you see in that flattening out with those storage numbers that we saw before in terms of those overall percentages. Not a lot of these companies have immediately maturing securities. It may be 2 or 3 more years before some of these payments are due on some of their debt. They can renegotiate debt. Some of them will. Some of them will have some opportunities to do that, hopefully through some of these government supported loan programs, such as the Main Street program, although there are some concerns whether or not the oil and gas industry will qualify for that. And many have and will continue to try to secure more operational efficiencies. I was just looking at the numbers this week on productivity coming out of the Bakken and the Eagle Ford and the Scoop Stack regions. Just for this last week alone, productivity was up 18% in the Bakken and Eagle Ford, and 30% in the mid-continent region alone. Those are the kinds of things that keep people moving, that keep them surviving, that keeps cash flow going without expending too much capital and burning your cash positions. And that's what's got to happen as we move through the end of the year. But on a long run basis, this is an industry that's going to look a lot different. Probably a smaller number of firms, more concentration, overall production levels, and likely some lower production. But the speed and the strength of the recovery is going to really dictate kind of where we go in all of this. And that's the big uncertain. That new normal below 50 seems pretty likely. If for some reason we get this very, very strong and robust V-type recovery that some people are hoping for and anticipate, well, this number might change a little bit. I doubt it. Even in a strong V shape, that we have to take a long V for that to happen and a strong one to happen. If you're more of the school of thought that this is going to be more of a swoop recovery that starts out slow and continues to build, much like we did in the last 2008, 2009 recession, well, then this is probably going to be where we see the energy business, at least in the oil and gas side of the business, as we move forward into the next year or two. So with that, I want to thank you all for having me again. And I will open it up for questions. I'm not quite sure how we'll do that, but.
Okay, Chris, we've got a few questions. The first one is, would you be willing to share these slides with the club if anyone wants them?
Sure. And I'll coordinate with y'all on how to do that.
Perfect. The next question is, what is the price per barrel that the state bases its budget on? And what percentage is the state's budget of the price of oil?
So I think that from what I last heard, it's somewhere around 32 to 35. I'm not sure the exact point right now. So it has been adjusted downward. Those numbers in terms of overall mineral revenues as a share state budget, I think are somewhere in the 10 to 12% range. So they're nowhere near where they were, say, back in 1986. But there are still several couple $100 million that are out there. Pricing and the outlook for the industry is going to be important, not only, and the other thing to keep in mind is not just in mineral revenues, but what this means in terms of activity in the state for these companies that also generate considerable corporate income taxes, which is one of the big problems that we had, I think, in some of our budget crises after the 2014, 2015 scenario. Sales taxes, the other types of taxes that they pay that don't really get included in that 10 to 12% number that you see with just minerals alone.
Okay. We have a question from Laura Lindsay, wants to know, you mentioned finding new places for oil storage. Where are they and what does that all entail?
So I've seen crazy. So one of the things that has been very popular that are large sources of kind of off the book storage that is out there is floating storage, so very large crude carriers, and using them as storage facilities as opposed to just a transport medium alone has been where a number of companies have gone in terms of putting crude. Hess, for instance, I think secured a couple of million barrel VLCCs over the last year or so to hold crude. You've had other initiatives such as digging holes and lining essentially pits and pools to store crude oil. You've seen some acceleration in bringing some already under development storage facilities. I think in Houston this month, They accelerated the development in Corpus Christi of two different facilities. One was at 20 million barrels. The other was around 10 million. So it has kind of sent signals to the market that there have been some other discussions about going and storing crude at abandoned or closed down refineries, not just in the United States, but all over the world that may have some storage on site. I think there was some storage that's being utilized now at an abandoned facility in the Caribbean. So those kinds of things are where you're starting to see people utilize resources that they didn't know existed and have come in to help alleviate some of those concerns.
Okay, and Mike, I believe you have a question.
Yeah, I had one. David, what does your forecast indicate for the Louisiana oil patch, where a lot of people have been struggling, and the Morgan City and other areas, and what do you see for that portion of Louisiana's economy and those people who are directly impacted by the oil industry?
So, in looking at those relationships from a quantitative perspective, I know there's a lot of anecdotes out there about what companies are going to do. I really can't say much about those, but just kind of looking at the numbers and the historic relationships in the way we have tended to use those forecasts and develop them. We're looking at about a 5,000 employee drop here in the next couple of months to a year associated with that. That's a pretty significant decrease relative to the 35,000. I think it's about 15% reduction. I guess it could be worse, and there are some anecdotal discussions out there that there could be larger layoffs. I think it really depends on where you're talking about in terms of oil and gas activity. If you think about the offshore, say a little bit differently than onshore, there's going to be, I think, a lot more reticence with producers to let a lot of that very highly skilled offshore employment base get away during a time period like this, particularly when they've invested so much in them. I think there's going to be a lot of digging in to preserve that. Labor productivity is very, very high in that part of the business, and it has already undergone a lot of kind of employment correction in terms of reduction of jobs due to automation and technology anyways. That might continue, but I think for now, just letting people go is not something that you're likely to see. You're probably going to see more in the conventional onshore type areas, reworking wells, other types of activities, unconventional, where you're going to see those employment losses.
Okay, we have a couple more questions here. What is the future LNG exports in Louisiana with the Shale withdrawal from the LNG plant in South Louisiana look like?
So LNG is a tough market right now, and it's probably going to continue to be a tough market as we move through the next year or so for a couple of different reasons. Mainly the demand destruction that has occurred as a consequence of this, and the demand destruction in Asia in particular, where a lot of these cargoes were destined to go. The uncertainty associated where demand's going to be is another big problem. You don't drop $9 to $12 billion down on a lot of on an uncertain market. So it's a sector that's going to be very, very hard pressed, probably one of the most hard pressed in the overall energy business as we move forward, because it's just very hard to sustain $9 to $12 billion of investment on a very uncertain outlook. Right now, the prices and the differential between the deliveries in Asia and the Henry Hub, which is the main pricing point here in South Louisiana, is almost de minimis, which means you really can't almost transport the gas, liquefy it, put it on a tanker and move it and make any money right now. And that's kind of where we're at. So we're going to need crude prices to increase a little bit. We're going to need demand to increase a little bit. We're going to need to see a major correction and a reversal of where we are right now in order for LNG to start to take off again. Plus the fact that even as we move through the end of 2019 and into the beginning of 2020, it was a sector that was pressed with a lot of excess capacity even before this entire fiasco began. So not only do you have the excess capacity kind of pre-COVID, you couple this on top of it. That's a lot to burn off in a short time period.
And that was a Stephen Holliday asked that question. Thank you, Stephen. Next question from David LaCour: is the U.S. Strategic Petroleum Reserve filled to the brim?
No, it is not. There's probably about 6 days worth of production that we could put into the SPR right now. There have been some attempts to do that. In the first stimulus bill, I believe there was a provision in there to try to do it, which was stricken by I believe the Democrats in the House. There have been attempts to try to do that again under the argument that this, in the well-founded argument that in addition to helping the industry out, and keep in mind it's only 6 days, but it would be a very cheap way of filling up that reserve given where prices have been. That just hasn't happened. It's just been a political imbroglio that has prevented that from happening. It doesn't look very positive, at least over the next couple of months.
Okay, that looks like the end of the question, so I'll be stepping out here.
There's one more. Nancy Stitch asked, what will happen to the associated petrochemical businesses that utilize petroleum byproducts?
So I think, to me, the petrochemical business is also kind of dragged down in all of this. On the one side, you would think that this would be good for them because your feedstock costs are down, with gas around $1.80 and liquids down, pricing down because of the demand destruction. You've reduced those input costs pretty considerably. The problem is they're down because of the demand destruction, and that demand destruction is also the market that you would be selling those commodity chemicals to. So kind of the economic collateral damage in all of this is the problem for the petrochemical industry. So many of those facilities and the investments that we've made to date have been for the export market. That export market has primarily been focused on Asia. And until that Asian recovery occurs and is strong and sustained economically, and there's still some challenges there with that. There are some kind of green shoots that are popping up, but it's still a lot of uncertainty until that happens. Petrochemical is going to be another sector that is going to be negatively impacted by this, but primarily due to the fact that just their markets have contracted to such an extent. I mean, when many of these facilities were built and a lot of that capacity was utilized, they were based on forecasts that were looking at 8, 9, 10% GDP growth in Asia. Those numbers are going to be negative. We're going to see a recession in most of the Asian economies. And even when the recovery occurs, you're going to see relatively slow, well below 6%, 3, 4, 5, 6%, less than 6% type growth as we move out of that recovery. So it's going to take a while to get back to a level where we're looking at a big growth opportunity to move stuff into Asia.